Stephanie, tell us a little bit about yourself, like when you joined and.
So, my name is Stephanie Baker. I joined Lifestyles originally in 2011, and you know, did a lot of the education, but didn't get real involved because my career took off. I had family obligations. I ended up getting married. So by the time things kind of settled down, it was 2016. And I'll back up a little bit with the background information. I graduated from LSU with a master's in finance, and then I went into the banking industry as an internal auditor. And so I stayed in that field. I moved from banking to consulting services. I did consulting in aeronautics, in pharmaceuticals. I even did some consulting for Dr. Pepper. So, and then I also moved and did some work in computer services at EDS, for those of you kind of local to the area. When 2016 rolled around, my last position, I was the Chief Audit Executive for a $22 billion regional bank. Had a staff of 12. I worked 55 hours a week. And when I wasn't at work, I was thinking about work. So, you know, I got that, I set up the audit department at that bank, did it for about 3 years, and then had a chance to really kind of step back and say, what do I want to do? And I've always been interested in real estate. I owned my first single family rental in 2004. And so I thought, you know what, I've got this membership in Lifestyles. Let me see, where's the paperwork for that? So I basically reactivated that membership and started studying the seminar, the webinars. And that was in September of 2016. And in December of 2016, I did my first passive investment. Really liked that. And then in a few months later, then I got together with Don, and I said, excuse me, and I said, I really want to be a lead. So that's when I talked to one of the brokers in Lifestyles Realty and said, I would like to look for a property either in Denton or Bedford, because I live in Louisville. So I wanted something that I could drive to pretty quickly. And then we found Trinity Pines, and we put an offer on that and bought that property in 2017. Now, why did I join Lifestyles Unlimited? One of the things is, to me, it's a practical way to become financially independent. You know, being with a finance background, I began to figure out that I wasn't going to hit that $1 million that you should save in your 401k before you should be able to retire. That wasn't going to happen. Wasn't on the horizon. So I thought, I've got to find a different way how to, and really what it boils down to is, how do you have a consistent cash flow away from a job? It doesn't, you know, whatever age you're at. So I also wanted more control over my time and my money. Like I said, I was working 55 hours a week. I had a constant list in my head. Basically, there was a list for my company, and then there was a list for home. And I was just like, you know, at some point, I just want to have a list for me. So, and I had been in internal audit for 30 years. Been there, done that, got the t-shirt. So it's like, now I need to do, I want to learn something new. I want to jump into something else. And like I said, real estate had always been an interest for me. And, you know, what I like about Lifestyles is that you have a lot of support around you. So if I'm a newbie and I have questions, then there's plenty of people for me to ask. So that gave me a lot of confidence. So
Yeah, I know when I joined Lifestyles, like I said, I'd never owned any real estate before, but the level of comfort that I had knowing that I could walk into a room and if I had a question about something in particular, there was somebody in that room to answer it for me. Somebody had
yeah,
already been down that path before. It wasn't like, I think you should do, it was always, well, that happened to me and here's what I did. And this is, this is how I fixed it. This is how it was, I became more successful through that example. So, when you found this Trinity Pines, was 60 units? This
well,
was really
yeah.
interesting property.
What we did, so it was interesting. So it was April of 2017, and the realtor called me and said, "We've got this property. I want you to come take a look at it." And the property has 5 buildings to it. And when I went and looked at it, and I said, and the grass, it was over, the weeds were everywhere. It had a lot of deferred maintenance, but I think sometimes you get bitten by the real estate bug and it's like, this is beautiful. I have to have it. So, but it turned out that there were actually 2 properties. There were 2 different owners. One owner owned 2 buildings, another owner owned 3 buildings, and they both came up for sale within a day of each other. So I tagged them both, and what we did is we brought both of them to sale, to a closing at the same time, and wrapped them in one loan, and then basically reunited them together into 60 units and called it Trinity Pines Apartments. As you can see here on the slide, we purchased it in July of 2017, so we're coming up on our 4th year for a little over $4 million. There are 26 other investors, and we put up together $1.5 million, and that included the closing costs and also about $400,000 for rehab. Our initial financing is at $3,135,000. It's a 4.
Hold on a second, Stephanie. I got to ask a question.
Sorry.
Because you being analytical, you're going right down the list. But
Sorry.
there's new folks listening for the first time.
Okay.
And we just heard you put down 1.5 million. They don't have 1.5 million. You said,
Trust me, neither do
I've
I.
never seen $1 million. I know you had 20 investors. So would you mind just doing me a favor, Stephanie?
Sure.
What was your lowest investor in your deal? How much did they invest?
Well, the biggest investor is me, but after that, and Lifestyles requires that you put down 15%.
Right. Not how much you put in. How much did your lowest investor put in? The little guy.
My lowest investor put down $25,000. So I have several investors who put in $25,000. I have others that put in $50,000 and some $75,000, and I have several that put in $100,000. So
what I want people out there to understand, because they're watching for the first time, they haven't been to the seminar yet. So they're thinking, well, I'm a truck driver. Can I do this? Like she said, I like that Stephanie let the little guy get a chance, because you hear about these big real estate investor trusts. You have to be an accredited investor. You got to have millions of dollars. The little guy can involve themselves in real estate, invest in these apartments, putting as little as 25 grand in there. And thank you for doing that, Stephanie. And that's why I think it's important to stop right now, just to make sure they know that you don't have to have millions of dollars to do this. Real people, real results. You had some regular folks. And here's another quick question, Stephanie. You said you had over 20 investors, correct?
Yeah, 26.
Are they all from Dallas, or are they from all over the place? Do you have any out-of-state investors?
No, I have people from New York. I have people from Oklahoma. I have people from California. There are quite a few from Texas, San Antonio, Houston, Dallas. Yeah, so they're all over.
Now I got one more question for you. And the reason I'm asking these questions, I know new people are going to ask this, and they want to know this stuff. Well, you have a person from California, you had a person from Oklahoma. Did those people ever actually come to this property and look at it? Or did they just invest in it?
Not that I know of. Now, the people from Oklahoma might have driven down.
The point is when we find a good elite investor, we invest with them, and you'll learn more about this in the seminar.
Yeah.
Live where you want, invest where it makes sense. So you put in your 25 or 50 grand. I just want them to understand this before you go on the rest of it, that they could be living wherever and do this. Okay.
Yeah, and let me explain too. I mean, before anybody invests, we do a financial pro forma. So it's like this is what we estimate. First of all, this is the property, this is the size, this is the cost, this is what it looks like. This is our financial estimate of where we want to go in the next 5 years, and here's our business plan. We think it's going to take this much rehab. And then it'll start producing this kind of return. And then in 5 years, perhaps we'll take a look and we might refinance it or sell it. So all the investors get that information up front before they ever make the investment, and it's totally up to them. And we also, I took questions. Anybody has any call? We did a call, I think, to discuss the property. So yes, it's a very informed process before people, make their investment. So
let's look at the investment.
Okay.
Okay, that's where you started. Let's see.
So these figures are as of February 2021, and they're for the last year. So our total income this last year was $687,000. That's rents and other income. Our expenses were $370,000, and that includes, we've got salary. I have 2 employees, a maintenance person, a property management. Of course, that's utilities. That's just the normal operating expenses of a property. Our monthly cash flow after we pay expenses, mortgage, everything is about, it averages around $11,000 to $12,000 a month. That's that monthly cash flow is for the average over 12 months. Our net operating income is 300 for the year has been 316,000. And then so our cash on cash return is about 8.7%. So that's pretty much, what the property is throwing off on an annual basis. It's our returns are growing 8.7%.
Yeah, and Dave's going to talk this weekend a little bit more about that NOI, which is the net operating income, which in multifamily and commercial real estate in general, that's what determines your value. So,
yeah.
We do have the ability to increase that NOI through operational efficiencies, just rent growth. We do have some control over it, where single families more, what did the house next door sell for? We have a little more control over that in multifamily.
That's kind of the whole goal with multifamily too. It's kind of a balancing act. You're very much more focused on your budget, because it's like, okay, how can we increase income? And sometimes you do it. It's not only the rents. It's like, do you charge pet fees? Do you, we have a transfer fee if somebody wants to transfer between apartments. We charge back water. There's lots of different ways, lots of different fees.
And you also do see how much water you can save just from operating.
Well, we changed a lot of the lighting on the property, and we went to LED, so that lowers the cost of the electric. So I was going to say, you increase your income, but you're also trying to minimize your expenses. So
right.
We have low flow toilets. We replaced a lot of toilets with low flow toilets, so we've decreased the cost. All right, this is Trinity Pines before. So when we bought the property, this was one of the apartments that this was the previous seller, the previous owner leaned over me and he said, "Hey, we just got this eviction. We did you a favor." Meanwhile, they left this mess for us when we took over the property. As you can see, you've got, the blinds are broken. You've got old furniture here. If you look at the carpet, it's pretty much beyond help. And if you go over to the picture all the way over on the right side, that's the living room, where you've got an old sofa, You can see all the stains on the carpet, and right below it is the condition of the bathroom. That's the vanity. And then in the center, this was an upstairs apartment, as you walk up, there's this big hole in the siding. And believe it or not, that hole got bigger because it turned out that there were a couple of boys in the apartment next door, and every time they went down, they pulled a chunk out of the siding. So yeah, we had to like, okay, hold it. Anyway, we got all that fixed, but that's, and the only thing about that picture that was too bad is you couldn't describe the smell because it was pungent. Let's put it that way. Here's some more pictures. As you can see, this was an outdoor picture, and if you look at this building, I mean, you can see all the satellite dishes. There were 11 satellite dishes on the property, so attractive. You look at the grass, we've got more weeds than we have grass. We've got big bald spots because the sprinkler system didn't work. And we've got this old rundown, concrete in the middle there. All right.
I remember that you said earlier in your presentation that there were two different owners and you unified this property to make it one location. And as I recall, they were different. The buildings were different colors.
Yeah.
And you went in there and unified the whole thing. So from the street, it doesn't look like it used to be two properties.
Exactly. Well, all the buildings were built by the same contractor. So, but 2 of the buildings were tan and 3 of the buildings were gray. So we painted the exterior of the other 2 buildings from tan to gray, so it looked uniform. And then we did, a lot of exterior renovations. We replaced broken siding. We had to repaint all the doors. We put new signage up. We did landscaping, and you'll see that. This is some of the interiors. Now, imagine you saw that old linoleum floor with some of the tiles missing. We put new flooring in. So we basically walked into these apartments, and one of the reasons I liked them so much is because they were built between 83 and 85, so they were still in pretty good condition. We had nice floor plans. The buildings were in good condition, but what they needed to do was basically a cosmetic upgrade. So we put in, here we have the black appliances, we put in the tile backsplash, we put in new cabinet doors. We resurfaced all the countertops, we resurfaced all the tubs, the sinks. We put in new hardware, so new floors. We put in the gray paint, new paint. When I say new hardware, it's like fans and lighting and mirrors and towel racks. So we really kind of brought these to life. And as we did this, we were then able to increase the rents about $150 per unit. We were increasing them to market rate. So it's not like, our residents had sticker shock or that the community, we stuck out in the community. We were just increasing it to market value. So here's some more pictures. This
Hey,
picture
Stephanie,
on the left.
I have a question though. You showed that before picture with the nasty brown carpet and the old sofa that was left behind.
Yeah.
Now, when you turn that unit, you made it nice and pretty and everything was crisp and clean. Mm-hmm. There was no stepping up from what it was rented before to, you didn't have to incrementally increase that. You were able to take the rent from, I can't remember your numbers.
So for example, like most of our apartments are 2-bedroom, we would take the rent from probably $800 or $750, $800, and we could bring it up to $900. And increase the value when you do all the calculations. That every apartment we did that increased the value of the property about $30,000.
Right. That's what I had. That's good.
Yeah, we did that.
That's the control that we like to have in the multifamily, multifamily properties, is being able to drive that value.
Yeah. Now, of course, when we were looking at the property, we did the calculations and we realized that the rents were under the market about $200. So it's just a matter of, okay, give a resident a good product and they'll pay the market rate. What we did also with our current residents, the residents we had, we gave them an option. We said, okay, you know what? We're going to increase your rent, and we usually did it a little bit lower because we wanted to keep the current resident. We're going to increase your rent $120. You have the option of moving over to this new rehab department. You get basically a new apartment. Yes, you will have an increased rent, but you're getting some value for your money. And a lot of them did that. You know, others said no, we choose not to. They moved. Then we brought in a new resident. So we didn't empty the whole apartment complex and do this. We did this, you know, gradually, basically as a lot of the apartments would empty. So we were usually rehabbing 4 to 5 a month, and that was a pretty good pace. Right now, we have rehabbed 55 out of 60, about 92%. The 5 that we haven't rehabbed is because we have residents in there. They don't want to move. We've raised the rent.
I was going to bring that point up, is that in this current market where occupancies are so high, a lot of times you don't have any opportunity to upgrade the units, to increase rents and what have you. But you got around that by letting them move over. These were residents that were already, you had gone through, they'd been through your screening process. You knew their payment history because
because you know, as we basically took over the property and we're kind of getting to know the residents, and you know, of course, if there was an opportunity, their lease came up and we didn't want to keep them, it's like, well, we're just not renewing your lease. But you know, other residents who worked really well, we gave them options and they appreciated that, and they could also see the whole property itself getting better, the exterior. As I said in this picture here, there you go. You've got a lawn that actually is watered and green. You know.
Yeah, I remember this was like a little lake down there.
This was a lake. If as you're looking on the building, do you see the gutter pipes running down the side? We put gutters on all of the buildings and we put drainage in the ground because before there was no drainage whatsoever on this property, and then when it would rain, you'd have 2 to 3 inches of water that would sit on the property for days. It was miserable to live in there. So
I remember that you were like, do I put dirt in it or do I just throw some fish in there?
Really. I mean, you'd get lost. It was at people's own private lake, and you know, we did things. If you look a little bit to the right side of the picture, we've got some grasses. We put some ornamental grasses on the property. We painted it. You look at the stairwells. We've got a dark gray, and that's kind of contrasts with the medium gray of the buildings. Yeah, and you know, another thing is that made a big difference, and this is free, is we keep the property clean. So anyway, I'm sorry, could you go back to the previous slide? Yeah, this picture on the right side, that's our office. We also, when we bought the property, it didn't have an office. So what we did is we took a 2-bedroom, 2-bath apartment and we walled off a section. So there was a storage room, we took a bedroom and then also a bathroom, and that's our new office. So we, new paint, new flooring, some wall decorations, new fan. We put the French doors in there to give us access to the other rooms. And so now we've got a property manager and a maintenance man. And one of the reasons why this was important too is the previous owners did not have anybody on site. So the property was managed by off-site property management companies. And I wanted our residents to feel like we're here, we're accessible. If you need something, let us know. And putting an office on the property said all of that. And that's also gets into retention. You want to retain your good residents, and you want them to feel like that there's somebody here to take care of any problems that they have.
Yeah, that's
Okay.
often an amenity that gets overlooked. Having somebody that shows up and fixes things for you when it
Yeah.
breaks. So many times people moving into apartments think of, does it have a fitness center and does it have a dog park? But they'll forget all of that, but they'll remember if they had somebody come out in the middle of the night and fix their air conditioner in August.
Oh
That's
yeah.
really the main thing.
And we have people show up and it's like a mother says, I need a copy of the lease because I need to enroll my child in school and I need it now.
Right.
Just all kind of things. Packages get dropped off, but people like knowing there's somebody in the office, they're available. So that I think has really helped with retention.
I'm
Um,
sure it has.
yeah. Okay, next picture. Next slide. Here we go.
Okay.
Cash flow and cash on cash projections. All right, so year one is basically August of 2018, then year two is August of 2019, and then this is 18 months later at our current, as I said, February of 2021. So you can see where we had a steady progression in income. We also had a steady progression in operating expenses. That's not necessarily a negative. What that means is that we are actually we're turning on services. As I said, the previous owners, they didn't have staff. They didn't run sprinkler system. They didn't have somebody landscaping. So we're turning services on, and there you can see now the NOI, which is basically you've got your income minus your expenses. What's left over is your net operating income. It's done a steady increase also. Then you've got our mortgage costs, which stayed pretty steady, our net cash flow, and that brings us up to the current, which is about 8.7%. I will
Hey,
say
Stephanie,
that,
I'd like to point out something. You were saying how your expenses increased,
yeah,
but and obviously they did, from what I can see here. But the thing that really jumped out at me was not the expenses increasing, but how much less the expenses increased in relationship to the income you were generating.
yeah.
Your income generation went up at a much more rapid pace than your operating expenses increased, which is why the property's worth so much more now than it was when you bought it.
Yeah, because we're doing the right things to get the income up. You're right. From year one to year two, you're looking at what almost $120,000 increase in income, with operating expenses went up about what 50,000. So
Right.
that's a
Pretty good
trajectory we
return.
want to go.
Right.
Mhm. I will say now our property was something that you would call a yield play, which means that it has some rehab in it, and that can take 1 to 2 years. So a lot of this cash on cash return, these returns went these net cash flow went back into the property, into rehab, because and I do a monthly newsletter to our investors, and I gave them the choice. It's like, we can do dividends, and I can do distributions, or we can rehab. We've got the opportunity to rehab 6 more units. Basically, you're going to add about $180,000 to the value of the property. So, it wasn't a hard choice. Most of them were like, yep, let's do it. We've got the opportunity.
Right.
So,
Next slide. There you go.
okay. Net income and property value projections. So here we go. So as we talked about, our net operating income at the time of purchase, year one, year two, and current. Now, property value. Our property value started at 4.4 million too. So when we bought it, we captured about 200,000 in equity. Now, year one, as we're doing more rehab and we're spending more, doing the rehab, doing and adding services, our NOI went down, therefore our equity capture went down a little bit. That's normal. as the property is kind of coming up. Year 2, you see our net operating income go up, our property value goes up, and our equity capture of 1,000,001. Now, these last 2 squares, they have 2 numbers in there. I put that in there because I wanted to show everybody that you work hard, you do as much as you can to increase the value of the property, but outside market forces also have a pretty big impact, and it's important to keep an eye on what the market is doing. So under this current column under property value, so if market demand for real estate and pricing would have stayed the same as it did when we first started out, our value of our property probably would have accrued to like 5.2 million. That was our original projection. Well, it turns out now with the pandemic, and also about year 2 it started, you saw this really increasing demand for multifamily real estate. And so right now, and I'll kind of give you a little bit of a background, if you think during the pandemic, hotels weren't making money, office buildings weren't making money, people were canceling leases. So the one place that we're still producing was multifamily. People still needed a place to live. So you've got a lot of money, and it's still happening. A lot of money is coming out of those other areas into multifamily. So currently, our property is valued at about $6.88 million. That's not an exaggeration. And I've been talking to realtors and others, other leads who are also, selling property. And basically, so our equity capture right now is 2.8 million. That's in 4 years. The value of this property has increased 2.8 million. So this bottom line, when it says a 70% return in 4 years, what that means is that that's a 70% increase in the price of the property. But if you take the out-of-pocket total that we put down 1.5 and divide it into this 2.8, you come out with 185%. Which basically means that for every dollar we put to work in that property, it's produced $1.85. So not only does my $1 come back to me, but I'm going to get $1.85 along with it.
But Stephanie, remember, what does it say? You also had the cash flow. So really, if they think about it, they really made about a 200% return if they really get it all in there. If you look overall, your internal rate of return.
We've done about $115,000 in distributions over the 4 years. Right.
Yeah. Well, during the pandemic, when everybody else was losing money, your investors were doing okay, huh?
They were doing okay. They were doing okay. We were watching real closely because multifamily had the challenge with the eviction moratorium. But you mentioned earlier how essential employees. So that was the thing. When I would go to the property in the middle of the summer, last summer, and you're looking at the parking lot and there are no cars in the parking lot, you're like, all right, I got apartments full of essential employees. So, they went to work and they paid their rent. And I was really concerned about it. But, somebody pointed out to me, they said, hey, nobody wants to be without a home during the pandemic. I'm like, you're right. So people kept paying their rent. They went to work, they came home, they paid the rent. And as I like to say, we provide clean, affordable, and safe housing. Absolutely. Not that fancy, but it's clean, affordable, and safe.
And you can feel good about it. And your investors can feel good about it because you took an ugly, distressed asset, made it beautiful, made a great place to live for all these residents. I mean, I'm sure they thank you. Like, wow, my AC actually works now. Wow, I don't have a flood out front. I mean, it's a good feeling, that what we do and how much we help society at the same time. I know it sounds crazy, but that's really what we do. And during the pandemic, while everybody else was crying and suffering, and by the way, this is the most excited Stephanie gets as an analyst, so that's how excited we make 180% return. It's still pretty darn good.
Yeah. So, the funny story is sometimes we'll have people come by the property and they go, is this the same property? Did y'all have change in management? Yeah, we did. So,
Yep.
Yeah. So our residents there, they come and they stay. So, and I
like how you said it, it's a lot of it's about retention, or as I say in the seminar, it's like marriage, it's cheaper to keep her. So we want them to stay there, and by you providing all these things, they actually have an office now, they can meet that. That is all part of that retention. In the industry, it's like a 50% turnover. Lifestyles members has a lot lower of a turnover because best product, best price, and best people. All those were factors, and you merging two together, you got the economies of scale to do it the right way now. So it's all powerful.
Yeah.
So what's in the future for Stephanie? Let's talk about your goals.
Well, my goal is to, as it says here, increase Trinity Pines profitability, grow the revenues, and minimize expenses. And the market is really hot right now, so we're going to look at do we refinance or do we sell? So this is kind of a decision we're going to look forward in the next few months. My long-term goals, grow my real estate portfolio so that both my husband and I are financially independent. So right now he has, a W-2 job as a software developer. And he says he works for present money and I work for future money. So yeah,
that's sugar mama. He's your W-2. He's the sugar mama. He's the W-2. That's like my wife. She was working as a nurse for a while, but neither of us work anymore. I guess we're lazy people now. But.
Yeah. Well, he asks me regularly, so can I retire yet? Can I retire yet? I'm like, not quite yet, but yeah, we're getting there.
Right? Yep. Okay, cool.
We're getting there. And one of the things I appreciate is, so I work maybe 20, 25 hours a week in the business. It has allowed me to do so many other things that are just as important. We have elderly parents, so I'm able to take care of them, take them to the doctor, do all those things that you want to do. And so that's been a really nice benefit. How did I achieve this? And I touched on some of that earlier. I had joined Lifestyles in 2011, got real busy, reactivated my membership in 2016, did the education, connected with a mentor, met members, developed a list of potential investors, and developed a team of mentors, vendors to assist me. And one of the things that I want to camp on here is that last point. I would have never gotten to these results without lifestyle support. There's, especially if you're coming out from another industry, there's just no way all the people and all the items, the things you need to do to successfully run a multifamily property. And when I said, hey, I want to be a lead, and we found the property, and my realtor put the contract in, and then they looked at me and they said, okay, you need a real estate attorney. I do. Okay. Do you have any suggestions? Yeah. Here's 2 names. Call these guys. And if you want to get some opinions, send out a blast email, and there are people at Lifestyles who can tell you what they'd like to work with. So that went through not only just the underwriting and closing, but to continue to operate the property. Sometimes it's like, I need to put cameras on this property. Who do I call? Okay, and you ask out at Lifestyles. I get names. You call. Anyway, it just I don't know how you would do it without a support system. It's vital. It's essential. And actually, I kind of have a cautionary tale. I'd just like to say to the audience, if there are people out there who you're thinking of investing in real estate, really make sure that the people you're going to invest in have a good experienced support system around them. I have personal friends who looked into Lifestyles. They didn't want to pay the membership fee, and I get it. It's not cheap. They invested with other syndications and, bought a 200-unit property in a nice location after 4 years. that property is getting sold and they got no distributions and they're getting an 8% return. 8%. They could have put their money into a mutual fund or a stock index. And it's because that syndication didn't have good support. So think about, you really need people around you to help you do this.
And they could have, instead with the 4 years invested in your deal, made 180 and have to wear the pens and be peeing their pants excited. But ego gets in the way, or people being cheap. I agree with that, Stephanie. It's very common. People are too cheap to invest in themselves with education. I'm like, I don't know why you would want to buy $1 million asset with having mentors like Don at your side. It just makes sense to me. So.
Hey, Dave.
Yeah.
One thing that I was, well, two things. When I joined Lifestyles, I was amazed that, having a business background, we always guarded our financials, right? If you owned a convenience store, you weren't going to go down the street and share your financials with your competitor. Where here we do that. It's I'll open my books and tell you what I spend for certain items, and other people do that for me, and it's a big advantage to have that.
Well, Don, you did that for me. I was a new lead, and I think I was 6 months into it, and I'm like, I don't know what to charge for rent.
Yeah, I remember we discovered that. I think we had some of the same floor plans, right?
We have the same floor plans, the same contractor. Yeah. You came over with your rent roll and you said, here. Yeah. I'm like, thank you. Okay. Otherwise, I'm doing like market surveys and running all around town, and no.
Yeah, market surveys, you hope they're giving you accurate information.
Yeah, exactly.
Here's another thing to piggyback on what Don and Stephanie is saying. When I go up there and I teach in Dallas, where they're at, Denton, they have their apartments, but it's near Dallas, just so you know. Every time I do a case study like this, we have a mastermind group of all these lead investors. There's like 60 of them, and I see Stephanie there and Don there, and all these different lead investors. And they share all this information every month. What is your chance of success if there's 60 other people that own apartments around you, opening their books, sharing anything you want to know? Just think of that. And we do that every single month. It's very powerful. I guess you guys are doing it virtual now, right, Don?
At least for this month.
Yeah. So we go live again.
I think we all just are so looking forward to getting back and being in person.
Yeah, we miss people. Yeah.
I'm glad
you're wearing masks in your own house. Some people do.
Right.
So, well, you guys ready to take some questions from the audience?
Sure.
Okay. Go ahead, Nicole.
All right. We just have a few in there. So if somebody has another question that they want to ask, feel free to type it in. Let's see. Michael is asking about the size of the property, 60 units for your first property. That seems a little bit large, but how did you come to the decision to purchase a property that size? And did you have any reservations about it?
Well, I would like to say that it was a lot of forethought and planning. I originally wanted to buy about 30 units because I was told as a new lead, that's a good thing to start with. And as I said, I went out to this property and there are 5 buildings and they're all right next to each other. So my realtor said, well, these 2 are available. These 2 buildings, but the other 3 were pretty rundown shape. So I said, I can fix up these 2 all I want, but nobody wants to live next to a ghetto. So the next day she called me and she said, oh, you know what? The other 3 buildings are for sale. And I just went, tag them both, all of it. And then I realized that I had pretty much said, I'm going to buy 60 units. And then I went back to my bank account and I said, okay, we're going to have to stretch this a little bit further. And that's how I got 60 units. So it was a little bit of impetuousness, but that's okay. Again, I had the support system around me that was, it could flex. So.
Yeah, cool. Okay. And then I think you kind of answered this in the course of the presentation, but when the interest only period ends, will that dramatically impact your net cash flow? I think you're looking at your options.
No, it has not. Our interest period ended last September. So we started doing principal payments, which are about 4,000 a month, but because we've increased, we worked on increasing our income those first 3 years, that we could take that increase in stride. And we planned that because I knew that was coming up. So it's like, we got to get this income up.
Well, too, and as you pay down that principal, that's less of a payoff you have when you do sell it one day.
Yeah.
That just adds to that return that you already have pretty good momentum going. So.
Okay. Okay, and then a question from David about how you determine how long to hold the property. Is it the same as single family? And are the tax implications a part of that decision making with regard to when you're going to sell it or how long you're going to hold it?
So a couple of things I'm keeping in mind. We did, when we made this proposal to the investors about buying this property, we did a 5-year pro forma, which means we said in 5 years, this is what we think the property is going to be worth. And then we're going to go and evaluate, do we want to sell or not? So we've already exceeded that value quite a bit by at least $1 million. So what I'm going to do in the next few months is basically get some assessments, appraisals of the property, see what the value is. And, I'm also keeping in touch with people in the market, other realtors and leads, and is what the value is. And, you also look at, do you have much more upside in the property? We've done all our major renovations. And it's, again, it's a question of what's your goal? Are you for wealth accumulation quickly, or do you want something where you've just got that steady cash flow? And I myself and most of my investors, we invested in this for the wealth accumulation. So, at this point, it's looking pretty good.
And just to further on what she said is, when you come to my seminar, there's different strategies we'll have. There will be some people who do a 1-year hold and sell it very quickly, some 3 years, some 10 years. It doesn't matter. All of them work in multifamily. It is different than single family. Single family is a typical like a 3-year hold that we sell. But multifamily, Donna's had properties for 10 plus years where it's different, because in multifamily, we just refi our money out. So you can get a loan and then you get what's called a supplemental, a second loan on top of it, pull the money out again, tax-free. And we have something in multifamily that's different than single family. That's why we can hold them longer, called CapEx. And we actually have repairs and maintenance right there in our number. So it's a little bit different model than single family, but I will explain the differences in the seminar. We can't do a 5-minute explanation, but I just want to give you an overview really quick. So there's different strategies. Don, what's the longest you have an apartment now in your portfolio?
Okay, when I came on, I said I joined September 2006. I bought my first property in October 2007, and we still own it.
See, so that's 14 years.
Yeah, I gathered everybody together actually last weekend. We all like crammed into all of the investors. We just crammed into our community room there on property and sat down on 2 couches because there's only 6 of us. And
yeah, it was that Barney Rubble and Fred Flintstone from back in the day, right?
Yeah, right. No, but it's good. I think we've refinanced that property 4 or 5 times. So.
And literally you can apply like 100% each time, correct?
That allowed us to buy other properties.
Right.
So, the taxes, it's not free. One day we'll have to pay them, but my gosh, we've like 14, almost 15 years now that we have been pulling money out of this thing to buy other properties. So it's been a really nice little piggy bank for us and has kind of kept us going.
And if you're new and you don't understand, because I know it's a lot coming out, it's like drinking from a fire hose, I'll break this down in simple format this weekend. But when he says he refinance it 4 or 5 times, he literally would increase the value like Stephanie did. 2 years later, he pulled out 100% return through a loan. Well, because it's a loan, it's not a taxable event. So if you put in 100K, 2 years later, let's say you got another 100K, they would then invest that in another deal, tax-free. 2 years later, they can pull out another 100K, and he did this 4 or 5 times. So that's the power of real estate, and I'll teach you that this weekend. So what I tell you with taxes is defer, defer, defer. And that's what he's doing in this case, where he's not paying any taxes the entire time. Now, it'll come due one day where they sell, but now he's an investor. Here's another option. They can literally 1031 exchange into another deal and still pay no taxes. So there's options there. I just want new people to understand that.
Yep. All right. Leo would like to know what has been the most difficult part of doing the syndication and the renovation process.
Great question.
Wow. Learning a whole new career. So I came out of, like I said, internal audit and banking, and so I had 2 skills that were readily adaptable to this. And one was project management, so the renovation, and the other one was I was pretty good at managing people. My first 3 years in the property, I had a third-party property management company. Because I was new to this, and the lender said, you know what, you need some experience besides lifestyles. So I had a third-party property management company, but I took it as an opportunity to learn. So I was at the property at least once a week, and I talked to the property manager, and I walked the apartments with the maintenance man, and I actually got a lot of the vendors that we used on the property. So when we did the renovations, my property management company wasn't real strong in that area. So I ended up finding a general contractor to come in and do the paint and the floors and all of that, and make sure it stays on track. You got to be out there kind of motivating people. So that was a real learning experience. And then last January, right before the pandemic, who knew, I decided to self-manage it. So I released my third-party property management company and started my own property management company, and hired my own employees and set up my own payroll system and my own, application for leases and rent and all of that, the apartment management side of it. So that was kind of a whole nother learning curve. But we're now, almost a year down the road. So it's been a great, it's what I wanted to do. I wanted to learn something new. I wanted to have a new career. And I've accomplished that. And it's great to see the property prosper, the investors prosper. Like I said, it's a little bit like driving down the road 70 miles an hour while you put the car together. So.
And one thing I want to piggyback on what Stephanie said, and Lifestyles members get this: no one will care more about your money than you.
And you.
So as her taking on this project, if you have a third-party company doing everything, you do not grow as a person. This is why you want to learn how to do it yourself. And her investors know she cares more than they would. So that's why we do it this way. So you understand that.
Yeah. So.
Yep. Okay. And I guess got somebody on asking if, so for somebody who's more conservative and isn't used to leveraging their assets like this, how do you prevent yourself from being over leveraged, and how does this model help you kind of protect yourself from that?
When you say over leveraged, are you talking about the down payment versus the loan? Because pretty much your lender will reinforce. A lender generally will give you about 75% loan to value. Right. And they look very closely at the financials, every bit as closely as you do, because they don't want to, be in a situation where they've lent too much.
Can I speak to that? When I joined Lifestyles and when I first got into this was 2007, 2008. We are not over leveraged now at 25% in the deals. When I joined, there were people getting 90% leverage and then getting their refinance dollars cooked into the loan. That is over leveraged. 25% is no big deal because the lenders have learned through 2008 and 9 when everything blew up. These agency lenders have actually made these dust lenders, the loan originators, have actually made them responsible. So if they underwrite a loan too willy-nilly and it goes bad, then the guy who originated that loan has got to come back and put some money on the table to make up the difference in the losses. And that has really that's really made the industry a lot more sound. You don't have 90% leverage deals with 5 and 10% down in multifamily anymore. I think that's gone away, and I don't think that's ever coming back, and for good reason. And I'm glad that it's not. I certainly hope it doesn't come back.
And another big factor on this, folks, if you're listening for the first time, rule number 1 I taught, if you listen to my speech earlier, never lose money. So how do we mitigate our risk? What we teach here at Lifestyles is workforce housing. That already, we know it's an essential worker sort of thing. But there's one more thing. We make money when we buy. You heard Stephanie. Did she buy a perfect property that was maxed out at perfect cap rate? No. She bought a distressed asset. That leaves meat in the bone on the table for us to work with. We're buying distressed assets. We're not buying perfect ones. This way we know she can raise the rents over $100. That is huge. This mitigates our risk. Everything that they did on this deal mitigated her risk. And by bringing up the best product, best price, that's why they make such great profit. But you take the people, we call them California buyers, they're buying the perfect property after she fixes it up and there's no meat on the bone. That to me is risky. We don't do that here. We're buying ones that there's either a mismanaged property or this one, which was more of a value add opportunity where she fixed it up and elevated the whole property. So that's what mitigated her risk, having that extra equity in there, that forced appreciation.
Yeah. Also, I wanted to say, before, I was considering buying the property, Lifestyles, and I know, David, you'll talk more about this, but Lifestyles has a system, it's called a quick analysis, where they'll help you do the calculations to determine, is the asking price too much? Does the, and basically the income from the property, does that add up to the net operating income, the interest rate you're going to pay on the loan? So you kind of do that calculation, and then you sit down with your mentor and you go, look, these are the numbers. How does this look? Does this make sense? Am I paying too much for this property? I have looked at properties where the asking price was way too much. A lender wasn't going to fund it, and you couldn't get any returns out of it for your investors. It's like pass. So
yeah, we stress test the numbers. They can be 100% full, but we're not going to run it 100%. They can have their expenses this amount, but Don's going to sit down and say, "Oh no, the property's in this area. Here's what your expenses per door are once we put staff in." They're starving it because they're not actually have staff that they need on this property. So she knew all that going into this. That mitigated both her and her investors' risks. And she sends out a plan to her investors called a PPM and an operating agreement. Here's how I'm going to run it. Here's our exit strategy. All that's thought up ahead of time before you ever even put $1 in the deal. Okay.
Yeah, and again, you're in Lifestyle, so you've got experienced people around you, and they go, look, I have a property that's 2 miles down the street. This is what it costs me to run. So here, these are the numbers, and don't get carried away with what you wish it would be. Here's some reality.
There you go. Perfect.
Yeah.
Cool.
One more, Nicole.
Okay, so yeah, so as the residents' leases were coming due or coming up for renewal in the renovation process, you mentioned that you didn't renew some of the renters. They didn't renew some of the leases, and Timothy's asking, you can do that? You can not renew a lease? So
yes, you can. This is Texas. Texas is a landlord-friendly state, and you cannot you can decide you're not going to renew a lease, and you don't have to provide an explanation.
Yeah, it's called a notice of non-renewal. We give that. We don't even have to say why. It's really so we can renovate the units and raise it up. So Great question.
It doesn't have to be acrimonious. It's just thank you very much, but you know, we will not be renewing your lease.
So Stephanie, do you have some folks are coming to my seminar this weekend, first time? They're scared, never did real estate before. What advice would you give them real quick?
Surround yourself with experienced people. Real estate is a great way to make money. You know, I have a finance background, and one of the things that drives me crazy about the stock market is it goes up and it goes down, and there doesn't seem to be a correlation. To me, things should make sense. There should be a cause and effect. With real estate, you see it coming. You see the changes coming from a distance. You know what? You see the you see the increase in value. You also get an idea when it's going to plateau and when it might go down a little bit. But like Rick said, it's always going to come back. To me, it's just a much more reliable asset.
Well, thank you so much for sharing your story with us today, Stephanie. I'm sure your investors are happy as well. I'm sure you're going to come back and do another case study down the road with us.